They are one of the equity managers that we utilize with the pension and have for quite a number of years, and he's going to kind of address some things on the markets and all that and give some updates with that. Myself, I'm Brett Holland with Stifel, and Mike Battistelli with Stifel as well. To get started, just real quickly before we get started, we've not been able to necessarily speak to everyone directly here or individually, but we just wanted to pass our condolences along with Commissioner Ames's passing, and know that you all lost a coworker, but a friend as well. And we certainly, I don't want to speak for Mike, but we both very much appreciated our time, and we were able to work with him and interactions with him, and always appreciated his just practicality, quite frankly. So, but we just wanted to mention that. Do you have anything you want to share with that at all? Okay.
Thank you.
And Andrew, you're expecting him as well?
Yeah, he's, yeah.
Just want to get some clearance on that.
So if you take the report here that we normally share with you there, and if you'd open up, if I could ask you to open up to page 4, on the bottom right-hand corner, 4 of 11. And this is the normal report that we go through with you. This is ending the 4th quarter, so it's ending December 31st. And as always, or as usual, Mike will have updates through here in the last day or so. But if you look there in the top left-hand quartile, top left-hand corner of your booklet there, it has the total portfolio for the current period, which would have been the 4th quarter of 2021. The balance started at $146,225,784. And during that time, there were withdrawals of $2,608,052, and there was appreciation or growth in the portfolio of the $9,949,037, and gave us an ending balance at the end of the 4th quarter of $153,566,769. I kind of said that strangely, sorry about that. So it gave us a total return at the end of the quarter of 6.84%. And then for the year, if you kind of move 2 columns to the right of that, you see the year-to-date number. Again, we started the year at $139 million and took out $6.8 million in the way of withdrawals. And the return during last year was $21 million, and again giving you the balance of the $153 million at the end of the year. So it was a return of 15.7% return last year. Any questions on that at all?
The assumption 725?
Yes.
Yeah, I think it's 7.25, 7.5.
Between 725 and 7.5.
Yeah,
Me too.
which one it is. I always get them mixed up.
For sure.
So.
7.25. I think it's 7.25 because it was lowered
I think it was
a few years ago.
It was.
By 1/4%.
I can't remember how much though.
There we go.
I withdraw the question.
That'll teach you.
Bottom right-hand corner is just your allocation, kind of from a 30,000-foot view. It's showing cash equivalents at 0. It's actually cash equivalents is a little bit higher than that. It's less than 1% right now as an overall whole. Equities there on the right side of 64%, fixed income of 27%, and what they call alternative investments, which is the REIT portfolio, of about 8% is what that was at the end of the year. Now I'm going to ask you to go to page 6 if you would. Page 6, and I probably should have highlighted it, but down here on this kind of 1, 3, 5, and 10-year period, the 1-year period, again, we just mentioned that if you see the 15.7% was the return last year, I mentioned that. The last 3-year average per year has been 15.31. The 5-year average has been 10.3%. And then Commissioner Phillips, probably what you're referencing some there, the last 10 years has been 9.24. And that's some years higher, some years lower, but
This keeps pulling us closer to the consumption.
correct, yes, sir. So, so Mike has updates. Just one thing we did just want to mention, not to throw cold water on the conversation, but a lot of professionals that we would respect their opinion and so on, and Bailey might even have a comment on this too, but a lot of folks are saying the next 10-year expectations in the equity markets are probably going to be a little more muted than what we've seen in the last 10 years. It doesn't mean that things are going to be bad or horrible or anything like that. It's just things kind of ebb and flow on a global basis over time. So expectations are probably to be maybe a little bit lower than what we've seen in the last 10 years. So.
I think part of that, just to kind of piggyback on that, part of that is the last few years, well, even going back to the financial crisis, there's been a lot of monetary fiscal policy, and that's starting to get unwound now. I'm sure Bailey's going to mention this, but the Federal Reserve's looking at some rate hikes this year. They're not buying their bond purchases on a monthly basis. So all those accommodative policies have been beneficial to the market, and now that's being taken away. So it's going to have an effect on returns to some degree. So we're just kind of getting prepared for that. So I'll give you an update here. This is through yesterday. As most of you have probably know, just listening to the news, the market has been off to a kind of a rough start, something we kind of anticipated to some degree. But the current balance on the pension plan is $143,187,088, and currently it's down 5.84%. And there's been about $1.2 million of withdrawals so far between January and February. And allocation-wise, it's changed a little bit. The equities have come down, REITs have come down just a little bit, but we're at this point, we're not really looking to make any allocation changes. We're kind of comfortable with where we're at. We're within the investment policy statement guidelines, and I think for now we're probably comfortable staying the course. And just to give you some insight, I know Bailey's certainly going to talk about ClearBridge and the piece that they have. But just to give you some insight, we've had Kevin Karan in here in the past from Washington Crossing Advisors. They have steadily been building up some cash. Markets were kind of high. They're a value-oriented manager, so they were having trouble finding good value. So they currently, and I think this is a good thing for where we are right now in the markets, they currently have about 15% of their portfolio is in cash, waiting for this opportunity. And it'll present itself where they can maybe go back in the market and take advantage of that. But that's just one example of how your managers are kind of trying to navigate through the changing markets. Okay. Any questions? Okay. So again, I think what we'll do now is turn it over